Tanya, are you there? Tanya, can you hear me?
Yes, sir. Good evening, sir.
Good evening, good evening. So today it's you are there. Praveen ji will be with us, but he will be on mute. He has the tough task of managing his work and listening to this class. And and where is Shruti? Can you are you in touch with her?
Yes, sir. I'm in touch with her. Sir. I have called also, sir, and I have messaged her also, sir, but she is not
Let's see,
receiving.
somebody is coming in now.
Yes, sir. I think she is Shruti or what?
This is I don't have a name. Let me see. 6F2543F1. Today, can you please put on the video so that I know who is there?
Sir, Paresh.
Okay, fine. Paresh ji.
I joined from different device.
That's why, because this has a code here, na 6F25435.
Yeah. 6F.
I said this is a new participant. I should charge Neeraj for this.
Excuse me, sir.
Yes.
Sir, may I phone call to Shruti?
Do that. Put yourself on mute and call.
Yes, sir.
So, for the benefit of Paresh ji and Praveen, so last week we were doing mostly about equity. But, there are this whole subject, equity investing, it is, what shall I say, it's very complex at one level, and at another level, it is quite simple. So today's discussion, basically, I wanted, to just talk about, the two approaches which are there. Now, one is this technical analysis and one is this fundamental. So, and then also what is good for an average person. So when we actually, as people who have limited savings, who want to earn a better return than is possible in the bank, so what exactly can we do? So we normally think in putting a bit in some mutual fund, some amount in fixed deposit, some amount in, and we also think about equity. But then quite often, the approach we adopt to equity, I think, is quite often wrong. There is that somewhere at the back of the mind, there is this feeling that this will give me a fantastic return and things like that. And I have a feeling that that is one of the main reasons why we don't do so well in equity. Because we take some of the basic principles which we use in all other transactions, but we don't use them when we are doing equity. For example, let us take this very, this standard procedure. When you want to buy something, subject to the quality not changing, you would want to buy something at a lower price and sell it at a higher price. Alice is here also. Good. Okay.
Excuse me, sir.
Yes, Tanya.
Sir, Shruti was telling, and मतलब सर वो मैसेज की कि वो उसको शायद थोड़ा लेट ज्वाइन शायद वो थोड़ा लेट ज्वाइन करेगी या फिर शायद नहीं भी कर पाए.
Okay, no problem. Fine. ठीक है. Let's just continue with this. Thank you, Tanya. And good evening, Alice. So I was just saying, this is for the benefit of Alice mostly, that equity investing is something which is a little, what shall I say, it's a little difficult that way, to actually take the right approach to this. So what I wanted to do here is that we discuss a little about the options that we have, look at a bit of fundamental analysis, look at a bit of technical analysis, because these are the two main approaches that we adopt. And then towards the end, we look at what I would think is a common sense investing strategy. Like I was saying, see, normally when we want to buy something, we subject to the quality remaining the same, we would want to buy something at a lower price, so that like if you have to sell it later, you sell it at a higher price. Normal trading practice is that. But when we get to equity, quite often what happens is we buy impulsively. That is when we find that others are buying and that stock is in the news, it's a trending stock, and then we think that, yes, we should go and buy. Now, the problem with this approach is that when many people are buying the same thing, given the way market forces work, the chances are that the prices are going to go up. And if the prices go up, then you will buy it at a higher price than you could have bought it, which basically means that you have bought something in contravention of the principle that is normally there, that you buy something low at a low price. उसके ठीक विपरीत आप करते हैं इक्विटी में, औरों की बातों में आके या ये ट्रेंडिंग स्टॉक्स का देख के या टीवी में कुछ देख के या आपके पास में जो भी मैसेजेस आ रहे हैं उन सब चीजों को देख के आप एक डिसीजन अचानक ले लेते हैं, इंपल्सिव डिसीजन. देन टू मेक थिंग्स वर्स, लेटर ऑन क्या होता है कि if I come across news that this stock is not doing so well, in the sense that many people, the prices are falling, many people are selling the stock, without understanding the reason why this is happening, we normally get fearful, and then because of that fear, we end up selling the stock. But because so many people are selling, once again, market forces will push the prices down this time. And when the prices go down, we end up selling this stock at a low price. So at the end of it all, quite a few of us have had the experience of buying something at a higher price and then selling it at a lower price in equity. Alice and Tanya, who probably have not done any equity investing till now, will think that those who are doing this must be fools. But then you can add my name to the list also. Most of us who go into this equity thing, sometime, at least a few times during the course of our investing career, we end up making this stupid mistake of reacting and taking decisions impulsively. Now, what we want to do is look at what options are there for us. What are the options which are there for us to understand where we should invest? Now, one basic concept in this is that let us invest in those companies which are fundamentally strong. If a company is good, then let us invest in it. If the company is not that good, then it doesn't make sense to stay invested for a very long time, because then the risk of something bad happening with the company, forget about the share price for the moment. Just think that if there is a company and that company is not so good, we'll get to this, this word I'm using, good, later on. But let's simply say that the company is not so good. What will happen is that if you invest in this company, maybe right now it's okay, but over a period of time, its business model comes into question. The products that it's selling, it doesn't do so well in the market. Its market share begins to go down. And as a result of that, what happens is that its financial results begin to go down. The company is not doing so well now. Now, what will happen in such a case? Logically, the share price will be affected. And the price of those shares are going to go down, because the analysts will feel that this company is not doing well. There's no point in staying with this company. Now, those of us who had invested in this, we now will get caught in that trap of having to sell something at a lower price. So, what we need to do is understand which companies basically are worth investing in. And when we do that, then basically we are in a position to let's say make more money in equity than we would have made, let's say, by keeping the our funds, our savings in a, let's say, in a safer haven, like let's say a bank, or maybe in a debt fund, or in a fixed income instrument where the risk would have been less. So the first thing here, of course, we look at fundamental analysis. And in fundamental analysis, let me tell you, we should look at fundamental analysis in two ways. I think, Paresh ji, when you were here last, we had covered this till just before this part.
Okay, okay.
So we had covered this till before this. Last week, I was also doing this particular aspect, but this is an area where I think there is a need to, sort of work a little more on this, and we will try to do that today. So in fundamental analysis, what we need to understand is that we have to look at this in terms of quantitative fundamental analysis and qualitative fundamental analysis. So we will normally, of course, when you talk about the quantitative fundamental analysis, basically what you are doing is you are looking at the three main statements. You're looking at the balance sheet, first of all. And then when you look at the balance sheet of the company, you are asking yourself certain questions. For example, this company, it made so much profit last year. Did it reinvest that profit in the company? Now, if it reinvested, where will it reflect? Think of it like this. There is a financial statement. There are assets, there are liabilities. On the liability side, I have the sources of my funds. Whatever funds I have, where am I getting these funds? The sources are there on the liability side. So let's say initially the promoters put in their capital. That was my first source. After that, as I begin to run the company, I begin to sell goods, make money, earn profits. That profit begins to be, some of that profit I retain within the company. That means I reinvest that. On the balance sheet, where is this reflected? This part? Anyone? The profits that I retain in the company, which are supposed to be retained for the purpose of reinvestment, where will it reflect in the balance sheet? Paresh ji, Tanya, Alice, anyone?
In asset?
Think of it like this. Paresh ji, you see, this is a source of fund, correct?
Okay.
Asset is how you use the fund. So for example, if a promoter contributes, let's say 10 crores initially as the capital of the company, and with that 10 crores, let us say you buy different productive things, you buy, let's say, a factory. The factory is your asset. The money which the promoter brought in is the source of fund. That is like a liability for you. Why is it a liability? Because the company is expected to repay the promoter that amount of money. Because we always think of the company or the firm as a separate accounting entity. So when you make profit, this profit has to be added on the liability side to reserves and surplus. See, in the balance sheet, just below the part where we write capital, just below that, next line, you will find this thing written there, reserves and surplus. Now, what are these reserves and surplus? This is supposed to be the profits which you earn and which you retain in the business. Why am I using the word retain? Anyone? Is all profit retained in the business? Let's say that a company has a 10 crore capital. It invests this capital in the business. And then during that year, they make a profit, let us say, of 20 lakhs. Now, this 20 lakhs is, let's say, this is the after-tax profit. They have already paid taxes, 20 lakhs is left with them. Is this tax going to be retained in the business automatically, or is there something else which can happen? Can someone please try to answer this? Anya?
Not exactly getting the point, sir.
Let's say that a company makes some profit. Okay. A company which is there, it makes profit. When it makes this profit, what does it do with the profit? Try to remember. Because see, when we speak about fundamental analysis, one of the basic things you have to understand is the basics of reading a balance sheet, the most basic thing. So let me just try to clarify this again. A company invests money in some activity. After that, at the end of the year, it makes a profit. Now, this profit, is the entire thing reinvested, or can it be put to some other use also? Alice, do you remember anything about this?
Sir, some part of it can be retained.
Yes. Some part? The other part?
It can be further used for investment.
No, the part which is retained is actually used for investment. That's what I'm trying to explain. You are right. Some part of it can be retained. The other part will be given to the shareholders as dividend.
Yes, sir.
Remember? So, Paresh ji, Praveen, and Tanya, the basic thing to remember here is that when a company makes a certain amount of profit, that profit can be used in two ways. Either you take that profit and you give it to your shareholders as dividend, or you take the profit and you retain it in the company for investment. Mostly what will happen is that a certain amount will be paid as dividend, and a certain amount, whatever is left, will be kept within the company for investment. Now, the thing to see in a balance sheet is what investment did the company make? If you look closely, you will find this. Then the other thing is it raising additional capital? So today we will actually go to money control again and then take out some balance sheets and have a look at this. And I'll show you, I have some material already I've taken it from money control itself. So we will have a look at that and you will see. Income statement. Is it making a profit? So the whole purpose of the business is to ultimately make a profit. And not just make a profit this year or next year, but to make a profit consistently from year to year. So here, is it making a profit? And if it is making a profit, what is the return on capital employed? Can someone tell me what this capital employed is and what return is? Anyone? Tanya, you might remember this. Alice, you were there last time also, no? So you people might remember what some of these things. See, the basic concept to remember here is whenever we say return, we are referring to the profits made by the company. See, think of return like this. If I invest in the company, what is the company returning to me? What does it return to you? It returns to you profits. Now, what we want to understand is when we invested in the company, during the year it engaged in some business, it produced goods, it sold goods, and then it made a certain amount of profit. Now, this profit which it made is the return. This is the first part. The capital employed part is what? Employ means to put to use. If you take the word employ, so how was the capital put to use? The capital was used basically to buy some assets and for the purpose of putting in place a process, a manufacturing process. Now, what was the total amount of capital that we used? The sources of capital, like for this purpose, are what? One is the amount which the promoter had invested. Some more capital may have come from whatever profits were made and retained in the company. And you may have also borrowed. You may have taken some debt. You may have borrowed from the bank. You may have borrowed from the public by way of bonds. So this entire amount of money that you got, the capital which was there in the company, the profits that were retained in the company, and plus the amount that you actually borrowed, this is the total capital that you have. How did you employ this capital? So the assumption is that you took this capital and you employed it in the whole productive machinery that you have. In the production of goods. Now, on this total capital employed, which includes debt, so it includes the capital, it includes the reserves, it includes debt. In this entire capital employed, how much of profit did the company make? Where will I find this? The capital employed part, I can find from the balance sheet, because the capital employed will be reflected in the assets. And the other side, the profit part, I will find in the income statement. So if I take the profit and if I divide it by the total amount that was invested and I multiply it by 100, I will get my return. So is this return good? What is good here? Good is it better than the other operators in this other industries which are there, which are operating in the same business? Number two, is it enough to give you a good dividend? Is it enough to give you a return? And then finally, you look at the cash flow statement. Now, today we'll be spending some time on understanding this cash flow statement a little better. And I would very much like that here, you people sort of participate a little in understanding this. Because otherwise, it will be a little difficult for me to just explain this concept. And these are the basics of fundamental analysis. So if you don't understand this properly, it will not really, the purpose of the class will then get defeated. So the basic question we are asking here is, does the company have a free cash flow? Is it generating cash? देखो, think of it like this. कोई भी माल बना सकता है, कोई भी बेच सकता है. But ultimately, is it getting cash? कहीं ऐसा तो नहीं है कि वो उधार पे बेच रहा है. Cash is not flowing into the company. Or the amount that it is selling in cash is very small. बाकी उधार है और वो उधार collect नहीं कर पा रहा है. Is that happening? The other thing is when it buys goods, that part of it, to what extent are they getting credit from their suppliers? Are they getting any credit at all? Or do they have to pay cash every time they have to buy something? Then the company may also be investing in some other business. Apart from its own business, it may be investing in some other business. Is it getting any return from that investment? That's another, that if they are getting returns, then that is also a source of cash. So cash from investing, cash from operations, and cash from financing. Cash from financing will basically be whatever the company borrows. So mostly it will be an outflow. When they borrow, they will be paying interest, but there will be an outflow of cash. But what the impact of this will be that the amount of cash that the company has is going to be reduced. So the point out here is, we need to understand how to use these three statements. And if we can do this, we are in a position to analyze the basic functioning of the company. And then when we compare this over a period of time, over 5 years, over 10 years, and all the data is there in us, if you just go to Money Control or you go to capitalmarkets.com, you will find this data there. No problem at all. And today, I'm going to sort of request that all of you, you will log on with me to Money Control at some point later today, and we will go through some of these analysis together so that you understand what is happening. That's one. Now, and for example, when you were hesitating in answering, where reserves will reflect on the balance sheet, where plant and machinery will reflect. So we should again go back to the basics here, have a look at the balance sheet and see exactly where these things appear, so that we are very clear about this. If you're clear about this, then you're in a position to make some sort of a analysis. And then you're in a position to, understand whether the company is actually doing well or not doing well. So that was the first thing which we had. I had written something here which will not be that clear but we'll get back to this point here. What I had written was, Amazon generated cash and used the cash flows to develop Alexa and Kindle. Are all of you aware of this, Alexa and Kindle?
Kindle?
Yes, sir.
Yes, yes.
So, the interesting thing here is that Amazon, when they were developing this, they had such a high free cash flow. There was so much of cash always available with the company that they did not have to raise funds for the research and development of Alexa or for Kindle. Basically, they were able to do it just from this cash which was coming into the company. That is what cash can do for you. And so this is just one example, but we'll go ahead with this. Now, here I have written about various aspects which are important when we try to understand how well a company is doing. For example, we look at earnings per share. Now, what is earnings per share? Basically, earnings is once again another word for the profits, the after-tax profits of the company. And if you divide the after-tax profits of the entire company by the number of shares, you will get the after-tax profit per share. So that after-tax profit per share is the earning per share. It reflects the profitability of the company, how well the company is using the capital that has been invested in it. We look at the price to earnings ratio. So we look at the earning per share on the one hand, and we look at the price per share on the other hand. So what is the basic multiple here? If earnings per share is 10 rupees, how much is price? Is the price per share actually 50? Is it 60? Is it 70? What is it? Because that reflects how much of future growth the market expects to get from that company. You remember, Paresh ji might recall when we had, and Tanya also, and I'm sure, I'm not sure whether Alice was there or not on that day, when we had actually looked at this whole PE multiple thing, and we had taken it year by year, and I had shown you exactly how this thing works. Does anyone recall that? Okay, we'll try to get back to that some point today. Then we look at the price to earnings growth ratio. Basically, that means how much is this profit per share increasing every year? Is it increasing by 5%, 10%, 15%? That tells you how well the company is actually doing. If the profit per share is increasing, then obviously the company is earning more money. And if it's earning more money, then obviously it is doing a little better than it did in the previous year. So then this is a company which is using its funds well, it can actually do well. That was one point. Then we spoke about this, the dividend payout ratio. So we basically said that what is the dividend amount per share? What is the dividend which is paid per share? So this was one part. What is the dividend paid per share means if, let's say, the company has made a profit of 10, it may decide to give 4 rupees as dividend, and it may decide to reinvest 6 rupees in the company. That is the question I was asking earlier on. If it takes this decision to reinvest 6 rupees in the company, then this 6 rupees will reflect in the reserves and surplus of the company, and the 4 rupees which is paid as dividend will be paid to you as a dividend. So how much dividend does this company pay every year? So this will also give you an idea about how much the company is giving to its shareholders and how much it is reinvesting. See, whenever a company reinvests, it is expected that its productive capacity will increase. Let's say the sales will increase in the year coming. And as a result of that, because of this extra investment, it will end up making more, more profits. And then we spoke about, let's forget about this for the moment. These three, I think, are quite enough. So now let's just go back and, look at this. We also, these are some of the same ratios, but this time I've tried to give you what is known as the NASDAQ dozen. So the NASDAQ in the US, what exactly are the ways they look at in trying to understand how good a company is? So first they look at revenue. So revenue is another word for sales, the amount of sales which the company has made. Now, when sales are made, you feel that the company is basically achieving what it wanted to do. See, the whole purpose of producing goods, of the marketing effort that was made, the reason for its existence basically is that it should be able to sell its goods. So sales is the first thing that I look at. And there we look at whether there has been sales growth over the years, number one. Earning per share, we've already covered, and its growth over the years. Is that earning per share, the amount which you're getting, the profit per share, if you want to call it that, is it increasing year after year? Then the return on equity, the net profit divided by the shareholders' funds. The shareholders' funds, remember, is a combination of two things. It is a combination of the capital which was invested initially, plus all the retained profits. And all the retained profits are where? They are in the reserves and surplus part. That was another one. And then we look at recommendations. So basically, don't rely only on what analysis you have done. You also look at what analysts are recommending. Analysts are making the same sort of analysis. They are also looking at this, and they are looking at it with specialized knowledge. And at the end of the day, they are coming up with their recommendations about that company, what they feel about the future of that company. Look at that also. And then, of course, the earnings surprises. Has the company outperformed the expectations? See, the company will quite often tell you exactly what it plans to do, how much growth it plans to achieve in the coming period. And when it does that, you can look at the results later and see whether the company has done as it had predicted, or it has done better, or it has done worse. So let's say it is consistently outperforming its own forecast. Then you begin to feel that this company is doing well. The earnings growth, how much is the profit growing? The PEG ratio, what is the growth in EPS? The industry earnings. Now, the industry earnings is similar industries, similar industrial units, how much, similar companies, let's say in the same industry, how much are they making? And in comparison with that, What profit is your company making? What sales are those other companies making? What sales is your company making, the one you are analyzing? If you begin to look at these two things, you will begin to develop a comparative picture. And that is what is important. And then, when you look at all this, there are other things here which we will not consider, because this is basically from a stock market perspective. We will not look at this. But as you can see, these are the main things to be looked at when we look at the way the company is going forward. Now here, I'm giving you an example. All the figures here, let's be very clear, are from moneycontrol.com. So I'm giving you an idea about one company which is considered to be very good in its own line of business. So what does Dr. Lal PathLabs do? Anyone? Tanya?
Yes, sir. They test the test. There are several tests conducted over there, like of malaria and that all things.
Blood.
Yes, a blood test, several blood tests.
Blood tests, and they do, so I'm sure, have you ever used this? Anybody in the family who has used this?
Yes, sir.
Okay, Alice, what about you? Are you aware of Dr. Lal PathLabs?
Yes.
And sir, and also it gives very assured results.
Okay, very good. So you have a very positive idea about this, correct?
Yes, sir.
And Alice, what about you? Alice, what is your opinion about this? Has anyone used this in the family, or kabhi zarurat padi nahi iski?
Yes, sir. So I myself got
And you have actually used this. And were you satisfied with whatever service they gave you?
yes.
Okay, so see, and I can also put my hand up and say that yes, that has been my experience also. Now see, there are three people here sitting. Praveen ji is on mute, but I'm assuming that he is also with us. So 100% of the people sitting randomly out here, we suddenly look at Dr. PathLabs and we say, yes, this is the company which has given us good service. Tanya goes so far as to say that the results are very reliable. I think that is what she meant when she said assured.
Yes.
The results are reliable. Now, it will not be a surprise then to know that Dr. Lal PathLabs is among the top, let's say, companies in this sector, in this whole area of pathology, medical pathology and testing and all that. This particular company is right at the top. Now, look at, so when we say it is at the top, this means that more and more people are using this company. So its market share is growing. Its sales should also be growing. So look at the sales growth here. The sales growth between 17 and 18, the total amount of sales that it made, in 17, whatever sales it had made, it made almost 16% more sales in March 18. Then in March 18, whatever figure of sales was there, it made 14.76% more than that. Then in March 20, it made 9.89% more than it made in March 19. And finally, in March 21, it makes a sale of almost 16% more than it had made in March 20. That means every year, this company is consistently increasing the sales which it is making. What is the sales for Lal PathLabs, Tanya?
So,
what is it selling? Tell me this. It is selling a service, correct?
yes, sir, it's selling a service. Yes, sir.
So when all of us use Dr. Lal PathLabs to get a blood test, for Dr. Lal PathLab, that is a sale. So when you see that sales are increasing, in another way you can say that, yes, Tanya?
The services are good.
Now, that is one part. And the other part is more and more people are using Dr. Lal PathLab for the purpose of medical tests. That is clear, no? So already we can see that all of us sitting here have a good idea about it, have a good opinion about it. So we have used it in the past. So that tells you that the market coverage is huge. You are sitting in one part of the country. I am sitting in a different part of the country. Praveen ji is in a third part of the country. All of us have used this. That means their network is so good that they are everywhere. And they are able to do this. How are they able to give you this reliability? Because that company has taken its profits, the one which it earned in the past, and it has invested that in technology which helps it to make sure to analyze to make sure that the reports that they come out with are reliable. And that technological investment that they have made is what is keeping it at the top of the market. It is the leader in this segment. So if we say that this is a leader, how do we confirm this? So we go to where will I get this particular figure? Sales growth. Sales is where? Where will I find sales? So the fundamental thing in fundamental analysis is that you must know where you will find different items. So can someone tell me where I will find sales? Tanya, in which of the three financial statements will I find sales? Alice?
Sir, in the first one.
Which one?
So in March 21.
No. You're not understanding. I'm saying that if I want to find out sales, the sales figure of any company, in which financial statement will it come? Will you find it in the balance sheet? Will you find it in the profit and loss? Where will you find this?
Profit and loss?
Yes, Alice, you will find it in the profit and loss. I think now what we should do is, since there is some confusion here with regard to this, let's just open up a balance sheet and profit and loss. And first just go through, some of the, what I'll do is, I will open up the balance sheet of Dr. Lal PathLabs 2021. Okay. And I will share this sheet, this screen with you. And I think that will help us to first understand, these basic things. And okay, so let me just share this screen here. Okay. See, this is the balance sheet. Okay. Let us look at this. This is Dr. Lal PathLabs. Can you all see this? I'll just make this a little bigger. So this is the balance sheet of Dr. Lal PathLabs for as on 31st March 2021. Tanya, can you see this? Alice?
Yes, sir.
Yes.
Okay, now let's be clear about where we look for these things. When I say that we want to analyze a company, we need to understand where we will find all these figures. So for example, equity share capital, see this, equities and liabilities. This is the header, shareholders funds. So equity share capital is 83 crores. Total share capital is basically, they're just giving you the total out here. Reserves and surplus is 1093.94 crores. Then the total shareholders funds is basically this capital plus this 1093.94, which is 1217.09. Can you understand what has happened here? Can someone tell me what exactly is being shown here? Tanya?
Yes, sir. I will try, sir. So 1 minute.
Try to speak and tell me what exactly is given here. What was, see, how you explain this is like this. What was the amount that was invested by the promoter? That is the equity share capital. This is the amount of invested by the different shareholders, the promoters and the other shareholders. Alice, are you seeing this?
Yes, sir.
And then what is the profits that this company retained, Alice?
$1093.93.
Tanya, are you clear about this?
Yes, sir.
Reserves and surplus, this is the, you can see this is the profit which has been retained by the company. Retained by the company means it is reinvested in the business. As the business has expanded, we all saw that, Dr. Lal PathLabs, we all know about it. We are all using it. We also saw that its sales are increasing. Now, if its sales are increasing and its profits are increasing, look at this figure, how it is increasing. Is it still visible or is it too small? Is this okay?
Yes, sir.
See, the reserves and surplus figure, just keep your eye on this row here, reserves and surplus. Look at this, 503.37 crores. This was the amount of retained profit which it had, or let's say the amount which it had built up through retained profits in March 17. Then in March 18, this increased to 693. What does that mean? That means that it has increased by 190 crores. Where did this 190 crores come from? Tanya, Alice, just stay with me here and just tell me, where did this profit come from? Where did this amount come from? You can see that the reserves and surplus, which was 503 in March 17, it increased to 693 in March 18. Then
Sir,
it
3.7 was reinvested in this, and again it made a profit from it.
Okay. What was reinvested?
That 503.37. That surplus up.
Yes. This amount was reinvested in the company. Very good. It made a profit.
Yes,
next year,
again it increased.
See, so you can see that this 503 is included here in this 693. Don't think that this 693 is coming out of nowhere.
That means that the profit it has gained, it is 693.19 minus 503.3.
Yes. So about 190 crores is the difference. That is the extra amount which they have retained in the company. We will see in the profit and loss how much profit they had made. Just take a screenshot of this for yourself or open this particular screen and you'll see. We'll go back to profit and loss in a while and I'll show you there also what exactly has happened. So, okay, let's do that. I think that'd be better. Just a minute. See, this is how you actually get it. This is, you can see what I'm doing. Okay. Can all of you see this here? Profit and loss for the period. Where is the here? Tanya, Alice, can you see this here?
Yes, sir.
Yes.
So this is the figure for March 17. See, this is March 17 out here. This column, March 17. I'm going here. See, the company made, if you want to know how much profit it made in each year, then you have to look at the profit and loss statement, also known as the income statement. So when you look at that, you will get this. Now, you can see that it has made profit consistently. Now, this profit, which it has made, it is reinvested in the company. So this 231 figure is here. You can see that this has been reinvested in the company, and it is, you can see it here, 503, 693, 847, 900, 1093. If you look at year to year, you can see 231, 255, 292, 302, 374. Are you following this, both of you?
Yes.
Okay.
Yes, sir.
So the first thing which I want you to just take note of is, if you want to find out how good a company is doing in terms of profit, where will you look for it? You will look for it in the income statement or the profit and loss statement. And that particular statement you will get by going to Google and simply typing there profit and loss statement, put the name of the company. For example, we took Dr. Lal PathLabs, we put that there and we were able to get this. And you can see how easy it is to get it. And so this is the balance sheet part. This part is the profit and loss part, and this is the balance sheet part. So this is one. Look at the items which are appearing. These are known as items, line items. Look at this and see where these are coming. See, when you look at total share capital, reserves and surplus, this entire thing, this is the long-term capital of the company. That means ये पैसा कंपनी के पास में है. कुछ कंपनी के पास में शेयर्स के थ्रू आ गया है, कुछ जो है वो अपने कमा के इसमें ऐड किया है. ये पैसा सोर्स है इसके बिजनेस का. ये कहाँ मिलता है? ये मिलेगा हमारे बैलेंस शीट में in the liabilities side. This is the first thing that you need to remember. Now, if you keep looking, इसको non-current liabilities कहते हैं. Why is it called a non-current liability? Because ये जितने liabilities हैं, ये जो भी हैं, ये within 1 year किसी को वापस नहीं करना है. Any liability which is to be returned within 1 year. Suppose if you borrowed from someone and you have to return that money which you have borrowed within 1 year, then you will classify it in current liability. So see the short-term borrowing, but Dr. Lal PathLabs doesn't have that. They have not borrowed anything like that. Trade payables. Can anyone tell me what trade payables are? Anyone? Tanya, Alice? What is a payable? Anyone? When you buy something on credit. See, when Dr. Lal PathLabs, when it actually goes to work, it needs all those things on a day-to-day basis. For example, when it takes a blood test from you, they have that syringe, they have cotton, they have spirit, they have that entire kit which they use to take the blood, and that entire thing is basically disposable. They will only use it once and then they will have to throw it away. So they need to keep a stock of those things. So that stock of things which they have to keep, they will have to buy it in bulk. They will buy it from someone. So when they buy it from someone, are they going to pay that person immediately or will they pay him later? So in this particular case, you can see that they have bought a number of these things which they require for running their business. And these they have, this amount they have not paid. Why? Because the supplier has told them you can pay us after 30 days, you can pay us after 60 days. So till they pay, and they haven't paid yet, it is considered a payable. Payable means it has to be paid. So look at this figure. If you see that this is, can you see that this is increasing? It was used to be 50. It is now 62. It has gone up to 77. It went to 112 and then it went to 135. Now look, in 5 years, this has increased from 50 to 135. That means it has increased almost 2.5 times. What does that mean? More and more people are willing to give or sell items to Dr. Lal PathLabs on credit. What does that mean? Because they have faith in Dr. Lal PathLabs that this particular company will be able to pay it when the bill becomes due. So that tells you about the reputation of the company. ज्यादा से ज्यादा suppliers जो हैं वो इस कंपनी को उधार देने के लिए तैयार हैं. अगर वो उधार देने के लिए तैयार हैं, that means that it has a good reputation. Okay. So are all of you getting this?
Yes.
So we'll take a 5-6 minute break. What I suggest you do is you go to moneycontrol.com and take out this page and have a look at it. Or at least be ready with the page. Take a 5-minute break and we'll again come back and have a look at this. See, if you understand this properly, it will help you. That is my main purpose in trying to forcing you to look at this a little more closely. So I'm leaving this page open here. You can at least try to remember when you look at this page, you can see that these are the different items which are there in the balance sheet. You can have a look at this. And you can see these are the different years which are there. And these are the figures in crores. So whenever you want to find out a little about the assets and liabilities of a company, this is where you will look for those particular items. And this is how you will understand what is happening. Okay. So we will stop here, just take a short break, and I'll be back with you after that. So it's 2 past 7 right now. Okay, I'm back. So, Alice, are you following this properly?
Yes, sir.
Is there any question you'd like to ask, or you understand what basically I'm trying to do here? No?
Yes.
So this is the balance sheet, and here in this statement you can see all the expenses and the income. So this is also the profit and loss statement, sometimes also referred to as the income and expenditure statement. But in money control, they call it the profit and loss statement. Okay, in some places we'll find this referred to as the income statement. Now, if you want to do any analysis of a company, the primary thing is to understand what is the basically what you have to understand is, where will I find these different items? If you are able to figure that out, it's very simple. Then you can take it to the next stage and begin to analyze. So my purpose in showing you all this was to just show you people where it is possible to get this. Now, if you really want to get some value out of this class, then it is necessary that some of the things that we are doing today, you try to do this on your own. You try to, just remember this. All you have to do is open a Google page. Do you have your laptop with you right now?
No, sir.
You have it with you?
No, sir. I have my phone with me.
Okay, so can you, so later on, so please get your laptop. Tomorrow at least, please get the laptop. And try to attend the session with the laptop. That make it easier. Can you do that tomorrow?
Sir, it has gone for repair right now, so.
Okay. Then, but it would have been helpful if you could have done that. Now, then it would have been easier. Anyway, just look at this. I'll just look at what is appearing here. So this revenue from operations, this is the sales figure. So over a period of 5 years, how has the sales been? So you can see that the sales used to be 881 in March 17. It increased to 1024 in March 18, went up to 1164 in March 19, 1273 in March 20, and 1490 in March 21. So you can see that in a period of 5 years, there has been a tremendous increase in the sales. Then you can see, if this is the source of revenue, look at the expenses. Cost of materials consumed. This is not there over here for some reason. Purchase of stock and trade is not there. Operating and direct expenses, they're showing everything in this head. So basically, earlier they were showing it here, cost of materials consumed. You can see that for the years 2017 and 18, the expenses in this area, they were showing in this head, cost of materials consumed. Now they are showing it here. But basically, it's the same thing. And, excuse me, after that, you can see that employee benefit, that means the salaries, etc., which they have paid, the finance costs, whatever interest they have paid, depreciation, that is out here, other expenses are here, and then the total expenses are appearing out here. So I have my total expenses, the whole details are here. The income side is here. So I have all the income heads here, all the expenses heads out here, and I can then see that the profit is appearing here. So basically, everything that I need to know about the profit and the income and expenditure items of the company, I can find it by simply going to Money Control. This is not a paid site. You can simply go there, type the name of the company, type the name of the statement that you want, and you will be able to get this without any trouble at all. So that's you have to understand this. Now, now that I've shown you this, I'll take you back to the presentation and we can look at this. So now you can see where I got all this data. So all this data that I'm showing you here, the sales growth, the EPS, the earnings growth, the return on equity, all this is here. Now, when you look at this data, one thing which you will very clearly see is that this company has been doing very well. If it is doing well, then fundamental analysis, the logic is that it will be good to invest in a company which consistently does so well. So this is the fundamental thing that I was trying to explain to all of you about this fundamental analysis. Okay. The next thing which I wanted to explain was this thing about cash flow. So one thing you need to understand here is that all the transactions which take place in the company are not in cash. For example, when I sell, for example, when anything is sold, that sale, the company may not receive the money immediately. Maybe they will receive it after some time. So that means it is a credit sale. Can you understand this, Alice?
Yes.
So it is a credit sale. So that means a sale has been made, but the sale is, the cash has not been received in the company. That's one side. So when cash is not received, we create a receivable. That means there is a debtor somewhere, somebody who has taken a service from you, but who has not paid you. So that money you are expecting to get. So it is receivable. You will receive it in the future. So you create a receivable. Similarly, when you buy things, I just showed you in the case of Dr. Lal PathLabs that the payables are 135 crores in March 21, which basically means that they have bought supplies, but they have not paid their suppliers to the extent of 135 crores, which they will pay. Now, if I want to find out the cash flow, everything where a cash payment has not been made or a cash sale has not been made has to be adjusted. So that adjustment is done in this table here. So for example, how will I get the operating cash flow? That means how much cash actually flowed into the company. So you take the net income. Net income is basically that profit part, the profit before tax. You take that, add depreciation. Can you tell me this, Alice, why we add depreciation? Any idea?
Because it's like an expense for the company.
It's an expense, that is of course true, but why do you think it is added to the income to understand how much cash is there in the company? Let's just for a moment just go back to that screen where this screen here, just to show you, just so that you understand this a little better. See, ultimately, can you see the screen, Alice?
Yes.
So look at March 21. Look at total income, total revenue. What is the figure here? Can you just call out the figure?
1,541.
Okay. Now you look at expenses. What is this figure?
1,167.
67. So the profit is basically 1,541 minus 1,167. So the profit I am getting is 374. Correct?
Yes.
Now, in this think of this as net income. In that other, what I just showed you, that slide, I had written net income. Think of this figure here as net income. So I have income, this is my income, and I am netting these expenses. All these expenses which are there, I am netting. Now, if you look at the expenses, each of these expenses are actual expenses. That means cash is going out of the company. So direct expenses, I have bought something, cash is going out of the company. Employee benefit expenses, I have paid salary to my employees, cash is again going out of the company. Finance costs, I have paid interest to my lenders, once again going out of the company.
So in
Other
depreciation, in
Yes?
depreciation, it doesn't go out. So
Exactly. The depreciation is not going out of the company. That means even though the profit figure is reduced by the amount of depreciation, the money, this 69 crores, is still inside the company. That cash is there. They have made this book entry so that they can record the amount of depreciation, but it is still there. This was the point which I was trying to make out there. So when I go back here and I look at this, I can see that this is the reason why I'm adding depreciation to the profit. And similarly, the receivables have increased, so I'm reducing it, because this is basically a cash which I have not received. So even though the sales figure, so this 50 is there in the income. This 50, which of sales, whatever I have done, this is reflected in my income figure, but this money has not come in. They are with my debtors. So I have to reduce this because this cash has not come to me. I have made credit sales. Similarly, this cash has not left me. So since this amount has decreased, I am reducing it. And when I do all this, if I take 100, I add 150 and reduce this 50-50, I'll end up with 150. That means the operating cash flow that I have from my operations, from the business that I conducted, the amount of cash that I was able to generate was this. This is the point which I'm making out here. So you have a look at this, at this later. I've explained each of these entries here. I'll read it out for you so that it will be maybe a little clearer when you look at it. Depreciation, like you said, is an expense that does not result in outflow of cash. So it is added back as the cash is still with the business. This is first. Now, increase in receivables, this one. When the company makes a credit sale, it increases its income because it expects to receive the payment in the future. But the cash has actually not been received. So it is reduced from the income as the cash is not with the business. Are you understanding the logic here, Alice?
yes.
And in decrease in payables, when the company buys on credit and sells the goods, it increases its income. If the figure is coming down, it means that the company is getting less credit from its suppliers. So it is paying cash. So this is reduced from net income as there has been a cash outflow. So basically, because of this, what is happening is all that you are doing is you are just adjusting the net income figure with these cash, non-cash items, which are already included in the net income figure. And when you do this, you arrive at the actual operating cash flow. Okay. Now, from this operating cash flow, if you reduce the capital expenditure, you are left with free cash. That means this cash is now ready with you. You got a certain amount of cash from the business. You sold stuff, you produced stuff, you were able to generate a certain amount of cash. Then you needed to reinvest in the business, capital expenditure. And that reinvestment that you made, you did it from your cash flows. At the end of it, at whatever is left with you, that is free. That means that amount is yours. There is no payment that you have to make with that. That amount has been received by the company for the service that it has rendered. So that is basically referred to as the free cash flow. The capital expenditure, what is that? It means an outflow of cash. An outflow of cash. So when we reduce the capital expenditure from the net cash flow, we arrive at the amount left with the business. So an expenditure is necessarily an outflow of cash. Whenever we make expenditure, if we take it from the reserves of cash that we have. So if you reduce that, whatever is left, it's like your bank balance. That is the amount which is left with you. So this is the free cash flow. This amount is available to the business to be used as it sees fit. It can do with it as whatever it feels is the best utilization, it can do that. Now, if you look at this side, I've just explained to you here, a good business will have free cash flow and this FCF will keep growing. Every year, if you go to Dr. Lal Cash Labs and you do this analysis, if you look at those figures which I had put there, and you just do that analysis out there, you will see that this free cash flow is actually increasing year after year. So just remember this, a good free cash flow means more cash is being received by the business, less cash is flowing out. In other words, more cash sales are being made or credit periods are very short. So when you may be giving some sales on credit, that means you are asking your buyer to pay later, but the amount of time which you are giving him to repay is very small. So that's one. And less cash purchases are being made or credit periods are very long. And because you are doing such a great job of running your company, you are able to get more and more credit from your suppliers. So because of that, you're paying more and more things. You're using less cash, getting more credit to get your supplies. Now, I have written out here these exercises, which I hope you people can do on your own. Now, the whole, if you really want to make this class fruitful, understand this properly, it is necessary for you to actually do this. So I've just written it out here, step by step. Open Google, type profit and loss account, name of the company, get that screen which I showed you. Do the same thing for balance sheet, you'll get that screen. Do the same for cash flow statement, you'll get that. All these three are available to you. Open all three pages, and then you do a complete ratio analysis. So I'll show you that also. And you will have to check for these things. Does the company have free cash flows? Is the working capital being well utilized? So is the amount of receivables decreasing? Is the payables increasing? Are the payables increasing? What is happening? So we saw in the case of Dr. Lal Path Labs that between March 17 and March 21, the payables had actually increased from 50 crores to 131 crores. That means more and more people are giving credit to Dr. Lal. Then is the amount of receivables decreasing? That you will see again. That means the company is not giving other people credit. That is coming down. But more and more people are willing to sell to Dr. Lal Path Labs. Why? Because it is a good buyer. It can buy a lot. So that's that. And is the average inventory growth very low or is it declining? In the case of Dr. Lal Path Labs, of course, this will not be a very major thing to look at because it's not a manufacturing enterprise. But if it had been a manufacturing company, this would have been relevant. Then is the company actually gaining market share? So you can look at the growth in sales. Now, is the sales increasing? So we had to look at that and we saw that yes, sales are increasing. So that was one. Then if you will need to make an Excel sheet, something like this. So this I have taken from Tata Motors. So Alice, can you see this?
No, sir.
Hmm?
No.
You can't see this?
Yes, sir.
Huh?
Yes, sir. Visible.
You can see, no? The Excel sheet?
Not the Excel sheet.
Okay, let me just open up the Excel sheet for you. Okay, can you see it now?
Yes.
Okay, so what I want you to do is take any company. For example, here I took Tata Motors. You can pick any company and you make it like this. You know, what you do is you will find these 5 years. You'll find these 5 years of figures in money control. You look at these items. For example, you take liabilities. In liabilities, you take trade payables. And you will fill in these figures, leave one column blank in between. And this column which I'm leaving blank, the purpose is to find out the growth between this and this. So basically what you will do is you will go here, select this, divide by this. You will get the actual growth which has taken place. From 11 to, just a minute. Just give me a moment. Let me just do it again for you. So basically what you do is you go here, and here you go here, put that within bracket. Come here and you tap the percentage bar. You can see what has happened. The growth here is basically 24%. My mistake. I'm showing it in the wrong column. You should do the exercise here actually. So Alice, follow this. I think this will be helpful. Open brackets, select this cell, put the divide sign, close brackets, -1. This is the, sorry, this should have been minus, I put equal to -1. You're getting this, and just type choose the percentage here, you'll get this. Now, if I take this and I copy this here, I should get this. So you can see it's -27% because the sales declined between 18 and 19. If I put it here, I'm getting -22%. If I put it here, I'm getting no growth at all. If I want it in decimals, I can do it. I can get 0.16% of growth. So you can see here, okay, did you follow this, Alice?
Yes.
So this particular calculation, if you do it for all these rows, you will begin to, and it's just a question of dragging, that's all. If you just drag this, you will get this calculation. You drag it like this. It will tell you how well the company is doing. Now look, this I have done based on the figures which are there in the balance sheet of Tata Motors. So if you look at the trade payables here, what are we seeing? We are seeing that the amount of credit from its suppliers is actually declining. So basically, it is getting less credit from its suppliers. Now, that is not generally a good thing. We just saw in the case of Dr. Lal PathLabs that the company was doing very well. It was getting more credit. Tanya, I think, is back after a long break. Welcome back, Tanya. Tanya, you were supposed to be back in 5 minutes.
I'm very sorry, sir.
Okay. So I was just showing Alice and Praveen that these are some of the things which you will have to do. There is an exercise which I have for you people, which you will do in your own free time. That is necessary. So I'll be sending this particular presentation to you. So you will see this. You will have to open this Excel sheet. I'll just repeat it quickly. So you'll have to open this particular Excel sheet. And in this Excel sheet, you will create this particular type of worksheet. From Money Control, you will get the figures. You will put the years here, March 17 to March 21. But between each of the years, you will put you will put one blank column. And in that blank column, you will calculate the growth. So here I have put the formula. Formula is basically this figure divided by this figure minus 1. So if you get how much has in percentage terms, what has been the increase between March 17 and 18? It is 24%. Between March 18 and 19, minus 27. So this sort of analysis you will have to do, and then we can discuss it tomorrow. But just try to spend a little time, just take half an hour, get the data and try to do the analysis, and then we can look at the results that you come up with. Then it will be meaningful. So I know today's class has been quite number intensive that way, but think of it this way. If you want to understand the basics of fundamental analysis, then it is necessary to actually, get into the, look at these figures and begin to understand how to use these figures. Only then will you be able to understand whether the company is doing well or not. So there's a little bit on book value here. Read about this. Tomorrow we will again have a look at some of what I told you, but that can only be done if you do at least some element of exercise on your own. Can I get a commitment from Alice and Tanya at least to do this? Alice will say that my computer is not there, then do it manually.
Sir, I will do.
Yes, Alice?
Sir, I will do it on my phone.
On your phone, it will be difficult. What I suggest is do it on a sheet of paper. Do it manually, it will be easier. Use your phone calculator and do it. Whatever you think. Tanya, can you do this?
Yes, sir.
Okay, then tomorrow I want to see both of you come out with whatever you have done and ask me questions on that basis. So to understand what results you have got. Pick any company. Don't take Tata Motors. Take any company. So we have looked at Asian Paints. We have looked at Dr. Lal PathLabs, two good companies. Today I just took Tata Motors at random, just so that to give you people an idea about this. And we saw what the figures were. You pick any company you want, and then we can continue. So now we come to a different type of analysis of companies, which is not based on fundamentals. That means it is not based on the the financial statements that we were looking at in the previous discussion. So this is based only on the actual prices. So a technical analyst is only interested in one thing. What was the price of the share on this day? What was the price on that day? And nowadays, because of the terrific computing power which is available, what was the price from second to second, from minute to minute during the trading hours of each day? So the technical analyst tries to find patterns. He looks for patterns. So the stock markets, as you know, they list the day-to-day prices of different shares. This is available. And the prices of each company can be studied over a long period of days. It will show patterns. Okay, so Tanya is back. So what I was saying, Tanya, is I'll be sharing this presentation today. You and Alice will both try to do this. And Tanya, do one more thing. Ask Shruti to also have a look at it and see if she can also, choose any company that she wants and do a presentation. I'll also put a message in WhatsApp. So Paresh ji, Praveen, all of you, if you can try to, do some of that analysis yourself, you will begin to get a good idea about that fundamental analysis thing.
I will tell Shruti to watch this lecture once more.
Do that. That will be helpful. Then, so now we're coming to this other thing. So just like we had fundamental analysis where we are looking at the actual performance of the company over a period of time. So in our examples, we were looking at Dr. Lal PathLabs over 5 years. Now, you can do it for 10 years. That doesn't matter. But the main point is you are trying to understand how well does this company perform from year to year. And to understand how it performs, I look at some key figures and some key ratios. So that was fundamental analysis. Now, if I want to understand a different way of understanding stocks and whether to invest or not, I look at something called technical analysis. Now, in technical analysis, I am not concerned with the financial performance of the company directly. So the financial performance is supposed to be reflected in the share price of the company. So I am now looking at this. So a technical analyst will say that the share price captures the fundamentals. If a company is doing well, it will reflect in the share price. If a company is not doing well, it will again reflect in the share price. If it is doing well, the share prices should over a period of time be showing a growth, upward growth. If the company is not doing well, then the share prices should be coming down. So if I study the share price on a day-to-day basis for a very long period of time, I should be in a position to understand if a company is actually doing well or not, and then take decisions with regard to when to buy or when not to buy, and of course, when to sell. So if I look at these share prices for a very long period of time, I will find that that certain patterns emerge. You'll find that some stock prices will keep going up week after week. Some will keep going on month after month. Some will go up, come down again, go up again. I'll show you some diagrams of that. Now, these patterns are not permanent. At some point, a stock which is moving up, share price is moving up, you will find that it will stop moving up and then maybe it will begin to come down, or maybe it will again begin to go up. There's no real way of predicting which way it will go, but the technical analyst, what he tries to do is use this data which is there and on the basis of the past, try to predict what can happen in the future. This is the point which he is making. So the idea is that, if a guy using technical analysis, if he can successfully enter the market at the right time when the prices are low and sell at a point when the prices are high, then he is going to be able to make a profit. That is the basic idea. Now, since the share price doesn't actually move, it's unpredictable, it can go up, it can go down. So sometimes it's also referred to as this whole theory is sometimes referred to as the random walk theory. Randomly, it's going up, it's going down, it's moving in whatever way it wants to. So this theory says that stock price movements are purely random, but the movement patterns over a long period of time can be predicted to a certain extent. So it said even though the share prices are unpredictable, they are random, but despite that, if we look at past data, if we look at past patterns, it is possible for us to do some element of prediction. Which way will the share price go? Will it go up? Will it go down? And if I can do that, then I'm in a position to buy and sell at the right time and make some money. So the assumption, of course, is that the share price is supposed to capture all the relevant parameters, the financial performance, the sentiments of buyers, every single thing is captured in the share price. So the stock price actually measures the true value of the company. That is the theory about this. Now, basically, like I said, it's based on past market trends. And when you begin to track the ups and downs of stocks, you are able to see patterns. Now, these patterns have various names. For example, you have a head and shoulders pattern, you have a double top pattern, this sort of thing. So what I've done is, I have taken diagrams of these different patterns, and once you see that, you'll begin to understand what this whole thing is. So look at this. This is a head and shoulder pattern. So Tanya, which is the head here?
Said that 181.
180 is the head. And 130, 130?
The shoulder.
That is the shoulder. Okay, great. Now see, what is happening is, imagine that the share price was at 100. So this line out here, this is the 100 rupees 100 line. The share price was here. Now, over a period of time, it reached 130. Okay? Then it began to go down. It reaches 100, but it doesn't go below 100. Now, you'll say, why does this happen? Fact is that if you look at the previous history, then they found that this is how much if it loses around 30%, it comes here, it tends to stop moving downwards out here, and then a new upward movement begins. Now, if this happens, see, it may not happen, but if this happens, a technical analyst will say that the first shoulder is here. The first shoulder is here. It is moving up towards the head. That means maybe we have a head and shoulders pattern in progress. It is happening. Remember, this is in terms of days. You are, let's say, this is on 1st. It reached here on 15th. It reached here on 18th. It reached here on 25th. So this is over a period of time. So when it is moving this way, this denotes the movement over the number of days. So day 1, it is here. Day 5, it is here. Day 10, it is here, like that. So when you are starting, if you look at a share price just today, you are at this point. So you don't know whether this will be the pattern in the future or not. But maybe when it reaches here and it begins to climb, then the technical analyst may say that yes, something is happening. The shoulder is here. The share prices are again climbing. Maybe I am seeing a head and shoulder pattern. So if somebody buys at this stage, let's say somebody buys here. And if the person is correct, then the chances are that the share price, which had come down from 130, will now go beyond 130. So I have hypothetically taken this, maybe it reaches 180. So if it reaches 180, after that, it is going to come down. But that coming down is in the future. So the technical analyst actually doesn't know whether it will start coming down today or tomorrow or day after. But if he has started at 100, maybe somewhere along this line, he feels that he has made a good profit and he can exit. Now, let's say that he at 160, the investor decided that let me quit. He invested at 100, he left at 160, he made a 60% profit, he's happy. Then he continues to watch this and he sees that this reaches 180. And after 180, he sees that it begins the downward journey. It is coming down. So now he sees that the head is also there. The first shoulder was here. The head has come. It's coming down. So now he knows that maybe I am seeing a genuine head and shoulder. So it is possible in the share market to sell first and buy later. You sell something which you don't have and you buy that later. That process is called shorting of stocks. So a person who, a technical analyst who is there, who's familiar with this shorting procedure, he can actually sell the stock somewhere here and buy it later on. So since he knows that the 100 is the support price because he has seen it happen twice, he figures that maybe this time again the stock will reach 100 and not be able to go further down and it will begin to rise again. So what he can do is he can buy at this stage, sell at this stage, allow it to reach 100 and then buy it back. So something which he had bought at 180, something which he had sold at 180, he is buying at 100. So he's making a neat profit of it. That is what this diagram basically means. And from this point on, he knows that the second shoulder is forming. So once again, if he wants, he can again invest out here and then sell at a higher point. Are you getting are you able to understand what I'm saying out here?
Yes.
Yeah, Tanya?
Yes, sir.
See, this pattern which is here, which is referred to as a head and shoulder pattern, basically there are various patterns like this which are there. Now, I'll show you another pattern. This is the same thing, but this is reverse. So in this case, it started at 100, went to 70, came back to 100, could not go ahead, went down to 45, and then again came up. So this is that same head and shoulders thing, but this time it is happening reverse. Now, if once again an analyst is able to predict this correctly, he is able to make money through this pattern. So the whole purpose of making this whole analysis, these technical analysis, is to identify such patterns. If these patterns can be identified, it is possible for someone who is good at this to make money. And I have seen people actually do this very well. They are able to understand it. And even though this may, you may think that this is entirely theoretical, this cannot happen, but it happens. And, the strange thing is that even though there is no great logic to it, these patterns tend to emerge again and again. So the only thing here is, if you can correctly predict this, you're going to make some money out of it. That's the thing. Now I'll show you another pattern. Look at this. This is called a double top pattern. See, one top, top two. This line here, because the share price could not go beyond this line, this is the line of resistance. And this is the line of support. So it began here, moved up here, came down, moved up again, could not breach this, came down again, and then this time it managed to go above the support, reach this place, could not cross this, dip down again, reach the support line, couldn't go below that, again went up, reached here, came down again. This time, breached the support line, came here, moved up, and then it began to go down again. Now, if, like in the case of the head and shoulders pattern, if an analyst is able to predict this properly, then that person is actually in a position to make some money out of this. So, so this is basically the, just a minute. So are you people understanding this? Getting some idea of this? We'll have a look at this again tomorrow so that you get a very good idea about what exactly has happened. And so since this is the first time that you have seen this, it may be a little overwhelming, but I'm sure that if you think about it a little, you'll understand. And you'll understand how people take decisions with regard to investments. There are different ways of doing it. One way I showed you was by the traditional method, look at the financials of the company, identify financially strong companies which consistently do well, and then you try to invest in those companies and stay with that investment for a long period. Because you have picked a good company, the company has done well in the past, you're hoping it will continue to do well in the future. As long as it continues to do well, the share prices should be rising steadily, if not very fast, at least steadily, and it will give you a return. Remember, you are trying to beat the best return that you would have got elsewhere. Whatever is your opportunity cost. If you were able to, the best return you could have got in a bank was 6%, if this particular investment can give you more than 6%, you are doing well. So you should not be thinking in terms of making huge wealth from this. The basic thing which you should be thinking of is, can I get a return which is better than the best possible return in some other asset? That was the idea. So we looked at that. So technical, fundamental. We'll go over this yet again tomorrow so that you have a better idea about what is happening. So any questions from any of you?
So we will again go through this and again we will see this. After that, we will ask the doubts.
But Tanya, it is necessary that you people do that exercise.
Yes, sir.
This exercise which I had asked both you and Alice to do, and I hope Shruti and Paresh ji can also participate, this one. This, going to Google and opening up, typing profit and loss account and the page. If you can actually do that, then I think it will be very helpful. You will be able to understand, even if you make mistakes, it doesn't matter. But then you will understand what exactly is done and what fundamental analysis is. And technical analysis, of course, I don't expect anyone to do it, but you should have a conception about what exactly it is. Because to do genuine technical analysis, you require to understand those patterns better, to understand how to interpret movements of share prices. And it requires, let's say, a much, much greater degree of, proficiency with statistics and these things to basically make sense of what is happening. Or you can just blindly follow the recommendations of technical analysts which come to you. So every day there are recommendations which are made, for technical people, technical analysts. They basically recommend कि buy this stock, sell this stock. You can actually use that. If you trust such an analysis, good. But let's be clear about this. If you try to just follow recommendations blindly, the chances of like consistently making money are not there. Sometimes you'll win, sometimes you'll lose. So it's not a very smart approach. Fundamental analysis is, I think, better that way. You'll try to understand what it means, look at recommendations which you receive, and then try to take decisions. We'll also look at this in more detail tomorrow. So we'll stop here today. And so Alice and Tanya, today you interacted a bit. Good. Tomorrow, I hope that you will both have done the exercises and you'll interact a bit more. And I hope Paresh ji, Praveen, Shruti all join us and we really have a better session, a more interactive session. Okay? Shall we end it here today then?
Sir,
Yes, Tanya.
sir, apart from this class, I have one doubt.
Now tell me.
Sir, there is a program in our college called as Sarjana, okay? Sir, there we have given मतलब एक उसमें बहुत सारा participation है जैसे painting के लिए, dance के लिए, drawing के लिए, sir उसमें एक ये business planning है उसमें लिखा है sir participants have to elaborate their business plan through PowerPoint presentation using maximum 10 slides. Each presentation should necessarily have introduction to the project, proposal highlighting objective of the business, beneficiary group or market segment, budget and profit estimation. Sir, तो कैसा project ready करें?
What we'll do is, Tanya, what you do is you call me after class and we'll discuss this separately. Okay?
Sir, may I call today, sir, or at tomorrow early morning?
Okay, tomorrow early morning.
Sir, after 8 o'clock?
Fine.
Yes, sir. Surely, sir.
You can do.
Okay. Thank you, sir.
Okay, fine. Okay then, good night, all of you.
Good night, sir.